Bailout is a financial term synonymous with the financial crisis of 2007 to 2008. But even then, bailouts were instrumental in history's most infamous economic crises. From the panic of 1972 and the Great Depression to the Great Recession and the COVID-19 pandemic, bailouts were the government's ultimate response to save companies, banks, and other financial institutions that were deemed too big to fail from complete financial ruin. It's important to note that the government mostly bailed out institutions that were vital to the national economy, or some companies that, if they were to fail, would greatly affect the economic status of a nation, country, or state. To save an institution from financial destruction, the government would inject it with sustainable capital to keep it afloat. This was often done through the purchase of a company's stocks, but the money spent to save such big-shot companies comes from taxpayer dollars. While bailouts mostly benefit the overall economy, they still come with risks, and unfortunately, these risks can affect the whole economy, especially taxpayers. To mitigate the exponential use of government bailouts, the US Congress passed new legislation to prevent further bank bailouts and introduced the option of bank bail-ins. Welcome to Luxo-Life, your partner toward personal growth and success. In this video, we're diving deep into the concepts of bank bailouts and bail-ins, their stark difference, and the potential effects they can have on the economy and your money in general. We want you to understand these financial terms and ideologies as easily and plainly as possible. So we've done our best to make sure our content is simple and straightforward. With that said, let's get started. Number 1. The history of bank bailouts and bail-ins. The concept of bailouts first rose to prominence during the dark days of the Great Depression in the 1930s. This era was marked by catastrophic economic collapse, massive unemployment, and the immediate fail of major financial institutions. Governments, faced with the impending doom of their economies, made a pivotal decision to intervene and rescue the endangered banks. These interventions took various forms, including injecting public funds into failing institutions and creating regulatory measures to prevent further deterioration. In stark contrast, the term bail-ins emerged as a direct response to the global financial crisis of 2008. This crisis, characterized by the unprecedented failure of modern financial institutions, massive taxpayer-funded bailouts, and the subsequent public outcry, prompted a re-evaluation of how governments and banks handled such institutions. To regain the people's confidence in banks and prevent massive spending of tax dollars, the US Congress passed the Dodd-Frank Wall Street Reform and Consumer Act in 2010. This act prevented the excessive use of bank bailouts and introduced the option of bank bail-ins. However, the provisions of bank bail-ins were a small part of the legislation. Ultimately, it was to prevent financial institutions from partaking in extremely risky lending practices, which were believed to be the major causes of the 2007-2008 financial crisis. Bail-ins marked a paradigm shift towards a more regulated and accountable approach. Instead of relying solely on taxpayer funds to rescue troubled banks, bail-ins introduced the concept of using the failing institution's assets and liabilities to stabilize it. This approach aimed to minimize the burden of taxpayers and hold the institutions themselves responsible for their actions. Shareholders, creditors, and investors were now expected to shoulder a portion of the losses, fostering greater financial prudence within the industry. However, it wasn't all good news. Keep in mind how shareholders, bondholders, and unsecured depositors would take the financial burden of failing banks. Number 2. The importance of bank bailouts and bail-ins. One of the primary reasons for the existence of bailouts and bail-ins is to maintain financial stability. During times of economic turbulence, financial institutions face significant stress from various facets of the market, such as housing and real estate. like what happened in the Great Recession when banks approved risky mortgage loans that came with adjustable interest rates known as teaser rates. Soon enough, the housing bubble inflated due to high demand, and many people were able to purchase houses via adjustable loans. Unfortunately, as said interest rates rose, mortgage payers couldn't afford succeeding payments, and the collapse of the housing market soon dawned on both borrowers and lenders. That's when the government steps in and bails out the lending companies through the Troubled Asset Relief Program, or TARP. Under TARP, the government provided financial assistance to struggling banks and financial institutions. Known as the biggest bank bailout in financial history, the US government spent $700 billion to support over 700 banks during the 2007-2008 financial crisis. This assistance involved capital injections, loans, and other forms of financial support to prevent these institutions from collapsing. The government also assisted borrowers and mortgage payers through the Home Affordable Modification Program, or HAMP. This allowed homeowners to modify their mortgage setup and avoid foreclosure. The Federal Reserve also implemented policies to lower interest rates and support mortgage-backed securities markets. Meanwhile, bank bail-ins have the same purpose as bank bailouts: to save a financial institution from the brink of failure. The key differences between the two is the source of the money spent to save the institution. With bank bailout, the government uses taxpayer money to save an institution from financial ruin. But with bank bail-ins, the institution uses its creditors and depositors' unsecured money to save itself. More specifically, the bank preserves its capital by canceling debts owed to creditors and depositors. A bank bail-in coerces shareholders, creditors, and customers to bear the losses of the bank to prevent its absolute liquidation. While that's an immediate cause of worry for those with money in the bank, the Federal Deposit Insurance Corporation, or FDIC, insures up to $250,000 for each bank account, meaning that if an account were to have an excess of $250,000, he would only lose the excess in the case of a bail-in. More so, according to statistical data provided by the Federal Reserve, the average savings amount in American household bank accounts is $41,600, far less than the FDIC insurable amount. What's more reassuring is the unlikelihood of bank bail-ins occurring in the US. Even the recent fall of the Silicon Valley Bank and Signature Bank was hardly called a bail-in. Ever since the legislation of the Dodd-Frank Act, bank bail-ins have become the new option for banks to preserve their capital and avoid liquidation. While it saved taxpayer money, it also put depositors' money at risk. Therefore, when the SVB and Signature Bank were shut down, shareholders and depositors naturally feared the possible losses. However, the FDIC assured that customers would have access to their funds even beyond the insured $250,000. Shareholders and those with uninsured investments could have still suffered losses though. There were two main reasons as why the collapse of the SVB and Signature Bank wasn't a bail-in. First, the SVB and Signature Bank were both seized and shut down, which meant that a bail-in couldn't save them from the start. Second, the FDIC used the Deposit Insurance Fund to bail out customers and insure their money as a whole. The Deposit Insurance Fund comes from payments made by the banks through bonds and interest, so no taxpayer money was ever involved. Number 3. The risks of bank bailout and bail-ins. Bank bailouts sure did have their place in the salvation of numerous businesses, financial institutions, and welfare systems. However, overuse eventually led to detrimental risks and effects against the national and global economies. The 2007-2008 financial crisis displayed the damaging consequences of bailouts in the economy, but ultimately the worst repercussions were the rise in national debt, uneven distribution of benefits, and the loss of trust. When the government is allowed to use taxpayers' money to solve financial problems, it doesn't mean that everybody's going to benefit. BailIns take away the risks and responsibilities of taxpayers and apply them to banks and shareholders. This economic shift has helped restore balance and trust, but it's a different story for those who bear the losses. In 2013, Cyprus confronted looming bank failures due to high-risk loans and investments. Unable to secure a global financial market bailout, the government resorted to a bail-in, compelling depositors with over 100,000 euros to absorb a 47.5% loss on their holdings. While this averted bank collapses, it triggered market instability and fueled apprehensions of more frequent bail-ins. Subsequently, in 2015, Greek investors pursued a lawsuit against Cyprus, seeking to recover losses exceeding 120 million euros. However, a 2018 EU court ruling dismissed the case, citing a lack of evidence for violations of property rights, legitimate expectations, or equal treatment. Number 4. The benefits of bank bailouts and bail-ins. Both bailouts and bail-ins are instrumental to prevent or mitigate the consequences of financial crises and economic downturns. While they can affect the finances of many people, they are often beneficial in the long term, and governments also work diligently to offset the effects of bailouts and bail-ins on people's money. Ultimately, bank bailouts and bail-ins are options made out of necessity rather than choice, and their purpose is to preserve major financial institutions whose downfall would greatly upset the overall economy and restore consumer confidence in said institutions to promote long-term benefits such as fair trade, business growth, job creation, and housing. If you liked this video, please give us a thumbs up, subscribe, and click the notification bell so you never miss out on any of our awesome and educational content.